of Management Studies IGNOU presents an audiobook on the course MMPC 014 Financial Management for MBA program. Presenting Block 2 Cost of Capital and Investment Decisions, Unit 7 Management of Working Capital, Part 3. Efficiency criteria. To a greater extent, a company's profitability is determined by how well it manages its working capital. In a dynamic domain like working capital, a single criterion would not be sufficient to judge or evaluate efficiency. Some of the criteria used to assess the efficiency of working capital management are: Number 1. Whether creditors have enough confidence in the company's capacity to repay its short-term obligations on schedule. As a result, a reliable indicator is whether a corporation can pay its debts on time. The finance department must prepare to keep enough cash in hand to cover the maturing liabilities. Number 2. Whether or not the highest potential inventory turnover is attained. Even the most efficient management of other components of working capital may not be enough to offset the negative effects of inefficient inventory management. Number 3. Whether customers are given reasonable credit. This potent tool for increasing sales should not be abused. Receiving credit is the flip side of the same coin. Both factors are dependent on a company's strength as a seller and a buyer in this case. Number 4. Obtaining appropriate credit from suppliers is contingent on the company's position with respect to its suppliers and the nature of the supply market. That is, whether there is a single provider, an oligarchy, or a large number of suppliers. Even if there is only one supplier and he has the ability to control the market, buyers can negotiate competitive loan conditions if their efforts are coordinated. At times, the supplier imposes the credit terms as 100% advance, that is, negative trade credit. And number 5. Whether there are adequate safeguards to ensure that neither overtrading nor undertrading takes place. The indices that can be used for measuring the efficiency in managing working capital are: Number 1. Current ratio or CR. CR is equal to current assets over current liabilities. It demonstrates a company's capacity to manage day-to-day business operations. It's beneficial to look at the working capital trend over time. Though the current 2:1 ratio is regarded optimum, it may need to be adjusted depending on the unique circumstances of a specific sector or industry. It is not only the quantum of current ratio that is important, but also its quality, that is, extent to which assets and liabilities are really current. Number 2. Quick ratio or QR. QR is equal to liquid assets over current liabilities. Current assets minus non-quickly realizable assets are referred to as liquid assets. In most cases, inventory and sticky debts are classified as non-quick assets. The optimum relationship between fast assets and current liabilities is 1:1. However, it varies from industry to industry depending on the conditions of that industry. Number 3. Cash to current assets. Cash to current assets equals to cash over current assets. Because cash does not earn any profit on its own, if cash is a substantial item of current assets, it may be a good sign of the organization's profitability. However, because cash does not earn any profit on its own, the proportion should normally be maintained low. Number 4. Sales to cash ratio. Sales to cash ratio is equal to sales over average cash balance during the period. The purpose of this ratio is to turn the cash as many times as possible in order to make maximum sales with the least amount of cash in hand. Number 5. Average collection period. That is, debtors over credit sales into 365. This ratio explains how many days of credit a company is allowing its customers to settle their bills. Number 6. Average payment period. Average payment period is equal to creditors over credit purchases into 365. It indicates how many days of credit is being enjoyed by the company from its suppliers. Number 7. Inventory turnover ratio, that is ITR. ITR is equal to sales over average inventory. It indicates how many times inventory has cycled over in order to reach the sales goal. Inventory should be kept at a level that balances production capacity with sales demand. Number 8. Working capital to sales. Usually represented as a percentage, it denotes that a certain amount of working capital is necessary for a given amount of sales. If a sales growth is planned, it must be ensured that working capital is sufficient. As a result, this ratio aids management in preserving appropriate working capital for anticipated sales growth. Number 9. Working capital to net worth. The relationship between working capital and the funds owned by the owners is explained by this ratio. When this ratio is not closely monitored, it can lead to Number 1. Overtrading when market conditions are favorable. The symptoms include a high inventory turnover ratio and a low current ratio. Number 2. When trading and the market conditions are not favorable. The main symptoms are low inventory turnover ratio and high current ratio. As a result, effective working capital management should avoid both surplus and deficit working capital scenarios. Hence, an effective working capital management necessitates good management of current assets, as excess current assets provide no returns. Further, since cash and marketable securities are the least productive, they must be managed with greater caution. Cash is a term that refers to a company's liquidity, and it plays a significant part in a company's growth and profitability. To avoid technical or legal insolvency, it is critical to create an accurate assessment of the financial requirement and plan accordingly. As a result, good cash management is required to provide enough liquidity. Determining the optimal cash balance. The excess cash is a non-profitable investment since idle cash does not generate any income. On the other hand, a cash shortfall may prevent a business from taking advantage of cash discounts and other advantageous opportunities. It may also result in the loss of creditworthiness as a result of failure to pay liabilities when they are due. As a result, every business, regardless of its size or industry, must identify the right or optimal cash balance. In general, A company's cash balance may fluctuate over time, so it is a good idea to look into the maximum, minimum, and average cash requirements during a given time period. You are aware that cash is required for a variety of business activities. Maintaining a cash balance, on the other hand, bears an opportunity cost in many ways. They are: number 1. Cash can be used to purchase assets such as inventories or securities. If a specified minimum cash balance is not maintained, investment opportunities may be lost. Number 2. Having cash on hand means it can't be utilized to mitigate financial risks associated with short-term borrowings. And number 3. An over-reliance on domestically generated cash might isolate a company from the short-term financial markets. The financial manager should now be aware of the advantages and disadvantages of having cash. After that, he must devise a model for calculating the optimal quantity of cash. To begin, a key minimum cash level should be established below which the company will face specific and measurable costs. Institutional requirements like credit ratings, checking accounts, lines of credit, and so on justify the presence of the minimum amount in addition to risk aversion. The failure to maintain a minimum cash balance will result in shortage costs, which will be defined by creditors' actions such as deferring payments or failing to take advantage of cash discounts or other incentives. At any point of time, a firm's cash balance can be represented as closing balance equals to beginning balance plus receipts minus disbursements. There will be no problem if receipts and disbursements are equal for any unit of time. On the other hand, if the receipts are greater than disbursements or vice versa, the final balance will fluctuate. Receipts and disbursements do vary in practice, especially for businesses with seasonal activity. If revenue and disbursements are not synced, but the variance is foreseeable, the key challenge will be to reduce total expenses. You will face large transaction costs if you set the balance too low. You will lose interest if you set the sum too high, which you can earn by investing cash in marketable securities. Under these conditions of known certainty, determining the optimal cash balance is similar to the inventory problem. The cost of little cash, that is transaction cost, can be balanced against the cost of too much cash, that is opportunity cost. Management of cash flows. The cash flows could be properly and effectively managed by certain techniques and methods. They are: number 1, speeding up collections. To limit the amount of cash held, the interval between the sale of items and the cash collection should be as short as feasible, and the flow should be managed. Normally, certain elements that cause time lag are outside the management's control. There are certain elements that should be considered in order to improve efficiency. They are: number 1, all money gathered should be deposited into a single account. If there are many collection centers, all cash receipts should be transferred to the primary account as soon as possible using the technology available. When compared to a single collection center, the total amount of cash required will be higher when there are multiple centers. As a result of the concentration of collections in one location, the company will be able to manage its cash more efficiently. Number 2. The period between the consumer sending a check and it being credited to our bank account should be minimized. Companies that have a lot of collection transactions use a lock box system. In this arrangement, post boxes are rented at various locations where cash and checks can be dropped off. The local banker can collect the money from the lockers on a daily basis. Service charges are paid to the collecting bank. Banks may be asked to create strategies to speed up cash collection in order to save time. Number 3. The transfer of funds from one account to another has become simple with the present evolution of digital banking. The customer may be urged to send the funds via National Electronic Funds Transfer or NEFT or real-time gross settlement, that is RTGS, so that they are received quickly to the credit of the firm's account from any bank and location. In fact, for transactions up to Rs 2 lakh, the immediate payment system or IMPS could be promoted to ensure that money is received immediately. These developments resulted in the discontinuation of the practice of issuance of checks or demand drafts for making payments and have led to efficient management of cash than in the past. Next is recovering dues. Receivables are generated after products are sold on credit, either as a convention or to promote sales. It may, however, be beneficial to reduce the amount of money held in receivables by ensuring that they do not become overdue. Discounts for early payment may be offered as an incentive. A continual follow-up activity for the recovery of dues is more crucial than anything else. This will help to enhance the cash balance situation. Next point is controlling disbursements. It goes without saying that increasing collection speed aids in the conversion of receivables into cash, thereby lowering the firm's financial needs. Delaying disbursements can provide a similar type of benefit. Trade credit is a free source of finances since it allows us to pay creditors only after the agreed upon credit period has lapsed. The payments might be deferred until the deadline. This will lessen the need to keep a big cash balance in hand. Some businesses may want to take advantage of checkbook float, which is the time between when a check is issued and when it is actually presented for payment, either directly or through the bank. Next point is investment of idle cash balances. How to calculate an acceptable cash balance and how to invest momentarily idle cash in interest earning assets or securities are two other essential areas of cash management. The first portion, which dealt with the theory of determining an acceptable cash balance, was already discussed. Now, we will talk about how to invest your idle cash balance on a temporary basis. Cash does not generate income on its own. If we know that we have more cash than we need for a short period of time, we must invest it to produce income while maintaining the benefit of fund liquidity. We must compare the benefits of carrying more cash, that is, more than the minimum need, against the drawbacks of not carrying it. Carrying additional cash may be necessary in the future due to unpredicted or unanticipated demand. Cash flows cannot be forecasted with 100% accuracy according to experience. it is difficult to estimate cash needs effectively due to competition, technical advancements, unanticipated product failures, strikes, and changes in economic conditions. The last point is investment criteria. When it is understood that the surplus cash will be idle, it should be invested in a method that will provide income while also ensuring a speedy reconversion of the investment into cash. When selecting channels for investing any idle cash balance for a short period, make sure that the investment is free of default risk, which is the risk of not paying interest or repaying the principal on time. Also make sure that the investment will mature in a short period of time and the investment will have adequate marketability. The ease with which an asset can be changed back into cash is referred to as marketability. It has two interconnected dimensions, price and time. If an asset can be sold quickly in large quantities at a price that can be predicted in advance, it is considered highly marketable and liquid. Now let's summarize the unit. To function properly and economically, every business needs finance. The short-term uses of funds are reflected in a company's working capital. Apart from long-term assets such as buildings, plant and equipment, money is also required to cover day-to-day operational expenses, for which cash kept in various current assets are used. For example, cash is used to purchase stock, which when sold results in a cash inflow either immediately or after a time lapse in the case of credit sales. The rate of current asset turnover in relation to overall sales during a given period is essential to the total funds invested in those assets. Many factors influence the amount of money that has to be put into current assets, and it might fluctuate over time. Some of the main aspects impacting the quantity of working capital are the manufacturing cycle, production policies, financing conditions, growth and expansion needs, and inventory turnover. The requirement for operating capital is amplified by inflation. The steady growth in input costs, if not matched by a comparable rise in output prices, adds to the management's burden. However, by adopting a number of steps on the production front, as well as keeping a close eye on managing expenses and expediting credit sales collection, management can restrict or at least reduce the need for additional working capital. Management should ensure that working capital is used appropriately and efficiently. Various financial ratios can be computed and compared against the specified rules for this purpose on a regular basis. Cash management is just as vital as managing other current assets like receivables and inventories for effective working capital management. Too little capital may cause the company to become illiquid, forcing creditors and other claimants to stop doing business with it. When there is too much cash in hand, funds sit idle and decrease the overall return on capital utilized below an acceptable level. A sufficient amount of cash is required to fulfill any unforeseen contingencies or liabilities, as well as the business's day-to-day operational expenses. You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC 014 Financial Management. Course coordinators Professor K. Ravi Shankar and Professor Kamal Wagricha. Voiceover by Harpreet Kaur. Edited by Savita. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.